US the economy next year, and also an additional 3 million people out of a job, pushing unemployment rate to 5%.
And again, we do have the 10-year now yielding 3.88%. More on the Federal Reserve coming up in just a moment with our Christine Harper. American Airlines climbing after saying it expects to post third quarter sales above prior guidance. American Airlines, mixed picture today for a lot of the airline names. We do have American up now by 3.4%, UAL up 0.4%, Delta down 0.4%, Southwest up 0.6%, JetBlue down 0.7%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Tuesday. Carol Master along with Tim Stenovic. Well, as we mentioned earlier, you know, what's past is prologue, which gets us to a story in the upcoming issue of Bloomberg Business Week. It'll be a new double issue out later this week. It's a story about Paul Volcker's inflation fight and how it hints at what lies ahead for the current Fed chief, Jay Powell.
Yeah, the Fed had to inflict a lot of pain in the 80s to convince markets it was serious. We've got just a fantastic guest with us this afternoon. Christine Harper is executive editor of finance and investing at Bloomberg Editorial. She joins us live in the Bloomberg Interactive Brokers studio. She's also, along with Paul Volcker, the co-author of Keeping at It, The Quest for Sound Money and Good Government. It's Paul Volcker's memoir. So, Christine, you spent a lot of time with the late former chairman of the Federal Reserve. I just want to start with that as some context here. Give us an idea of, you know, how he would, in your interpretation, look at the inflation fight that Jay Powell is doing today.
Well, I can tell you when he was writing his memoir back in 2017, 2018, nobody was paying attention to inflation. In fact, if they were at all, it was in an effort to get more inflation, right? So he was quite concerned that people were underestimating the risks. And so part of the mission of the book was to remind people of how important the central bank's role is in keeping inflation down and maintaining that credibility that he fought so hard to maintain. I mean, he had been involved in getting the dollar off the gold standard. And after that, the dollar was not connected to any actual value. And so when inflation took root, he had to, you know, drive interest rates up to unprecedented levels, cause all kinds of pain for people, for financial institutions, and the result was there was more credibility in the dollar. Some people talked about it went on the Volcker standard from the gold standard. But, you know, that's something you can't squander because he fought so hard. So it's kind of like having gone to war to to win a battle and then discover that your future, you know, commanders are allowing you to give up the territory again. So he would have been very upset that inflation was allowed to get to where it was.
We're talking with Christine Harper, and as we mentioned, this is in the upcoming new double issue of Bloomberg Business Week out later this week. Also with us is the editor of Bloomberg Business Week, Joel Weber.
Christine, thank you for those remarks. Also, just wanted to ask, you know, and you might have to extrapolate here a little bit, but you got to know Mr. Volcker very well. I'm curious what you think, if anything, Powell might have learned from him, and if not him directly, then the book.
Oh, yeah. Well, I mean, you know, as you and I have discussed, I mean, one of the things that's so interesting is how often Fed Chairman Powell invokes not only, you know, Volcker himself, who he says he's a great admirer of, but the book. I mean, he talks about everybody should read it, and he has used this phrase "keep at it," which people see as an echo of the title "Keeping at It."
Let's say that title one more time.
Keeping at it. And you know, the thing that I think Powell sees, and I mean, one thing that Volcker made clear was when I was speaking to him was how much he supported Powell as Fed chairman, because he liked the fact that Powell had this, similar to Volcker, had this experience of having worked in a private financial institution. In Volcker's case, it was Chase. In Powell's case, it's Carlyle and other places. And also working at the Treasury Department. So understanding markets, understanding the government is really important to being practical in the job and not just being an academic theorist. So I think Powell shares that sort of recognition that you have to win credibility from the markets, from the government, all these sides, and be practical in your approach and not just, you know, not just trust all the economists around you.
Christine, how tough was it for Volcker to hike rates? Like, what were some of the conversations that you all had about that, which was going against what everybody wanted but it was necessary in order to right the situation.
Well, to that point, I mean, he said that when he came into the role, it was clear. I mean, the reason he was brought in really was to do something about inflation that his predecessors hadn't really succeeded in bringing down. Even so, at that point, the economists at the Fed were forecasting a recession. So he had to sort of ignore that and just say, we're going to raise rates. There was a split on the Federal Reserve Board on the second time they voted. And so the markets didn't believe there would be any stronger action. They thought the Fed was going to lose their spine. And so he turned to this monetarist approach of just targeting the money supply. And that essentially told people, we're tying our hands and we're going to let interest rates go where they have to go. And they went up to like 20%.
That's pretty remarkable.
You know, there's a name in here that I did not expect to see that I wanted to ask about. Larry Kudlow, who was quoted by the Associated Press at the time, and he was at Bear Stearns then. What did Mr. Kudlow have to say?
Well, I mean, it was funny looking back at the clips because when Paul Volcker was telling me about this 4-3 vote and nobody believed it, he didn't understand really why nobody believed it, because he knew the people who were supporting him would keep supporting him, but the markets didn't. So, I did some research and found these comments that were made in the press at the time, including from then Bear Stearns economist Larry Kudlow, saying that essentially the fact that the vote had split on the FOMC showed that there would be a very timid approach going forward. The markets just didn't see the Fed being able to stick to their guns.
Okay, so I got to ask a question, because this book almost had a different title.
Oh, yes.
And we got to talk about that because it's just this little Easter egg. Can you talk to us about the parrot?
Sure, of course. So as I mentioned earlier, when we started working on the book, nobody was really paying attention to some of the central parts of Paul Volcker's legacy, including inflation. And so he was feeling a little, I think, overlooked. And so he opened the book with this very funny joke about a parrot, a wise parrot who's known as the chairman. And I encourage people to look at the book because it's a very funny little story. But he went so far as saying he wanted to title the book, The Wise Old Parrot Speaks. Now, the marketing department and I all agreed that was not a great title for this book. So we spent weeks trying to offer him other ideas, all of which he rejected. He hated all the pompous kind of, pretentious titles that a lot of other economists and people use on their books. So we were really going back and forth. It was one of the most difficult things of working with him because he was so stubborn on this. And so finally one day I was going through this long list of titles I'd come up with. I found a phrase from the Fed minutes at that time, sustained commitment. And he looked and he stopped and he said, keeping at it. And it was great because that really was him. He believed in speaking plainly. And, so he took the kind of jargony phrase and translated it. But I do think it would be funny if Powell was having to deal with the wise
parrot?
old parrot.
Everyone, it just goes to show everyone needs a really good editor. Okay, that's what it comes down to.
To save you from yourself.
Right, to save you from yourself.
Even Paul Volcker.
Exactly. Hey, Christine, I just want to talk a little bit about his legacy from a markets perspective and from an investing perspective as well. Given what we know about the 1980s and what markets did and what inflation did after he raised rates so significantly, what's in store this time around?
Well, I mean, I think everybody is seeing that interest rates are going to go up. The policymakers are making it very clear they're not going to back down on this. If they show any signs of weakness, I think people understand what will happen is kind of what happened to Paul Volcker's predecessor. So I think that is an example of where Powell sees he has to be steadfast. But as you would see reading the book, the chapters that follow the inflation fight are a series of financial crises that Paul Volcker's Fed had to deal with in the wake of the interest rate increases. And so, when you hear these experts come on Bloomberg radio and television talking about something might break, I think, what we saw back in the 80s was a lot of things broke. A lot of things were sort of, a lot of risks were built up, everything from the Hunt brothers speculation on silver to Continental Illinois, savings and loans, all these different banks that went belly up. And so the ultimate one was the Latin American debt crisis. And that was so bad that in '82, I think that was really what caused Volcker to say, okay, we've got to back off and stop the inflation fight. So ultimately, it is often that something breaks, that there's a financial crisis.
I think it's interesting on a day when the IMF has revised its estimates and the concern is about global central banks not doing enough. It fits right into your story and certainly your book. Christine, thank you so much. Christine Harper, check out her story in the new issue of Bloomberg Business Week. And of course, our thanks to Jill Weber, the editor of the magazine. Christine is editor of Bloomberg Markets Magazine. Thanks, guys.
Welcome our television and radio audiences, and really pleased to say we can get to an exclusive interview from the Robinhood Investors Conference. Our very own Sonali Basak standing by with a special guest. Sonali, take it away.
Thank you so much, Taylor. I'm sitting here with David Einhorn, who is the founder of Greenlight Capital. Welcome to our Bloomberg television and radio audiences. David, thank you so much for joining us here at the Robinhood Investors Conference. You are known as a classic value investor, but you've said so recently to your investors that value has not made a comeback yet. What is the point at which it does make a comeback, and are there specific signals you're looking for in the market for that to happen?
Yeah, first of all, thanks for having me on, and I'm thrilled to be here at the Robinhood Conference. It's always meant a lot to me. I helped found it 10 years ago, and this is our 10th anniversary, so we're super excited to be here and to talk, and thank you for having me on your program. Relating to value investing, I don't know that it ever comes back. There have been serious changes to the market structure, and pretty much most of the value investors have been put out of business. So if value investing is trying to do security analysis, think about what companies are worth, think about why they might be misvalued or misunderstood, and then do valuation analysis that tells you that in fact is true, there's just very few of us left. Most market participants these days, they either cannot do value, they're just not trained or experienced in knowing how to do valuations, or their structure doesn't allow them to. Like if they're an index fund or a passive thing, the last thing you're doing is value, or their system is a quantitative system or a trading system or an algorithmic system, or your style is to just buy things that have charts that go up and to the right. Right? And none of those participants are really doing value. So it used to be, that on every conference call of every company, there were like dozens of analysts from all of these competing long only, hedge fund, long short people and stuff like that, trying to hear what companies were doing and saying and trying to figure it out. And those staffs have been gutted because the world has moved passive. And so there's just a lot less competition for what we do.
Well, what does that mean for how you operate as an investor? If you're saying that so much of the world has turned passive or quantitative, has that made your job fundamentally different as somebody who picks specific securities?
It absolutely does. It used to be we could buy something at a reasonably low multiple, whatever we thought that was, think that the company would do somewhat better, benefit from it being somewhat better, and realize that other investors would see what we saw 6 months later, a year later, and would re-rate the shares. So you could buy something 11 times earnings, and maybe they would earn 10% more, but you'd get another 3 points on the multiple, and you'd make 50% over 2 or 3 years. That isn't happening anymore because there's nobody to notice what actually happens at these companies. So we have to be, the other side of that is nobody knows what anything is worth. So there's an enormous number of companies that are dramatically misvalued in ways that we haven't seen before. So whereas before we might pay 8 times or 9 times or 12 times, which seem like low multiples, but now we can buy a lot of those same companies at 3 times earnings or 4 times earnings. And if they're buying back 10 or 15 or 20 or 40% of their stock in some cases, eventually we're going to have to get paid by the company as opposed to having other investors figure out what we thought we figured out before them.
Well, to the extent you're seeing some better valuations in the markets to buy specific stocks, I'm wondering if you still think that there are bubbles out there in the market. We have seen a drawdown to a degree already. There's a lot of worries that drawdown might be bigger. And so do you still see bubbles?
Well, sure, of course, because the absence of people doing valuation means that nobody knows what anything is worth, and the market doesn't know what anything is worth. And so you had a period of time, like in 2018, where if you just took the highest valued companies, a priori, they went up the most, 30%, 40% for the top decile. The bottom decile went down 20%. So all you had to know was, is it already highly valued? And if it was highly valued, it went up more. And if it was lowly valued, it went down. And so you had this bifurcation of the market, and that bifurcation basically remains. So people look at those companies that ran away, and they were already overvalued, and they became even more overvalued, and they look at them now and go, oh my goodness, they're down 50%, they're down 70%, whatever it is, they must be cheap because deep value even one person I heard say, talking about stuff that was down a lot from a recent high. But all you're saying is it's at a discount to some previous price, which was obviously wrong. And so just because something, I would say on the way up, twice a silly price isn't twice as silly, but something that's half of a prior high is not deep value. In fact, the joke really is you know, what do you call a stock that's down 90%? It's a stock that was down 80%, and then it got cut in half.
So let's add in then the cocktail of higher interest rates, because some of this is based on, as you say, price to earnings or even kind of relative value, if you will. But what happens as rates rise? How do you discount where stocks should be, specific stocks in particular, as you know, the terminal value has not been decided yet on where the Fed lands?
Yeah, I think that is not the right way to look at things these days, because nobody's actually doing those calculations in any case. It's not like people are looking at it and saying, well, you know, with interest rates at 2%, I can pay, you know, 9 times for this, but at 4%, I got to pay 7 times for this. That's not really what people are doing. You know, what you basically have is you have companies where the value fundamentally disconnected, and you can figure out what we're in is a bear market. And so in a bear market, those things get derated. And you can say, well, the proximate cause of the bear market is inflation or interest rates or the Fed or all of those things. But in a bear market is when ultimately it turns out if you buy something and it's just at the wrong price, it's a long way down before somebody like me is going to want to come in and say, okay, this is actually really pretty cheap.
Pretty cheap, you say. We're in a bear market, you say, but are we in a recession? I'm wondering if you can kind of calculate the probability as you see it of what a hard landing would look like.
Yeah, look, understand, look, the politicians are debating whether we're in a recession. They don't really know what the definition is. You know, they also don't know what the definition of a woman is. So they're confused, and there's a lot of confusion, you know, that's out there on these type of things. I don't think it matters whether we're in a recession. I think what matters is things are in a slowing. And so what matters is the general direction of things. It doesn't really matter whether we're technically in a recession or whether it's technically a soft landing or a hard landing. What we are is we're in a period of economic slowdown or deterioration, and that's when things that were overvalued tend to get derated.
Talk to me about that slowdown. Do you think that as you talk to CEOs, as you talk to other investors, do you think that there's a mismatch here about expectations about where earnings are headed from here? Whether it's because the cost of financing for companies are going up, or whether it's because you think earnings revisions might go down further than you've seen them. Do you think that there's a mismatch out there?
Well, some earnings will go up and some earnings will go down. I think it's a company by company, you know, type of circumstance. You know, companies that are in energy, for example, I expect the earnings are going to continue to, you know, to be very strong, and materials and some other areas that are more benefiting from the difficulties that we have. You know, we've underinvested in some areas, which has allowed there to be a dearth of capital placed into, you know, not the software is eating the world companies, but the really boring ones. And, you know, when was the last time we put a cement factory in this country? And when was the last time we created an oil refinery? We've underinvested in these areas, and that's going to allow companies that are in these areas to earn excess profits for a substantial period of time because they don't face the normal competition that you'd have if we were trying to grow these sectors.
I have to ask you more about the role of inflation here when it comes to what companies are earning. On one hand, there's a concern that lower inflation would mean lower profits as well, but higher inflation, as we know, has also been an issue. This morning, Ray Dalio had told my colleague that he thinks structural inflation could be 4 to 5%. What do you think?
Well, Ray knows more about this than I do. I think we have moved from whatever that 40-year period of structural reduced inflation and deflation. I think we are now in an era of inflation, but I don't really want to quantify and come up with a figure because I wouldn't know how to make one.
Well, I'll follow up on something you said earlier this year. You had said that the Fed hiking interest rates at 25 basis points at a time was like taking an ice cream scooper to a driveway full of snow. Now that you're seeing the rate hikes be at a greater scale, do you think they're doing enough?
I think that they were very slow in getting started. I think the Fed chairman wanted to be reappointed. I think that slowed things down. I think it took them a long time to recognize the inflation. I think they, for a while, were like, well, let's continue easing because we only have 1.7% inflation, or let's keep easing because we don't have full employment everywhere. And we blew up a great big bubble and a lot of kind of things. I think the sad thing that comes from that is if we don't want to have a huge inflation problem, they need to do what they can about it. Frankly, I don't think the Fed has complete control over inflation. I think half of the inflation problem is a fiscal problem. And there's no discussion at all about making fiscal measures to either increase supply, which would actually be a nice thing to do, because if you increase supply, you increase wealth and you make people rich. Instead, what we're doing is we're trying to reduce demand, which essentially means lower everybody's standard of livings to try to fight the inflation. But nonetheless, the inflation needs to be fought, and the Fed, can only control what it can control. I think it's a mistake to put them as the sole responsibility for fixing this.
There's a lot of people who have a lot of concerns about systemic risks in the system, whether it's fiscal or whether it's something else. What do you think is the biggest concern out there that investors are not counting for?
Well, look, the systemic risks have built up in the government bond markets all around the world. From 2008 on, we socialized the financial crisis. We've socialized a lot of other things. The fiscal situation is difficult in all of the developed markets. Here we are, we're at the top of an economic recovery, and there's still $1 trillion deficit. And that's before rates change, before next year's COLA increases, before the economy slows, and before we decide whether we need to do something to bail out a weaker government like Britain or Japan or something like that. So there's all kinds of buildup on the sovereign, and it's not unique to the United States. All of the major developed sovereigns have this issue. We say here we're fine in the US because Japan has 250% debt to GDP and nothing so bad has happened there. But what if something is beginning to happen bad there? The yen has weakened considerably. They've had to intervene in the currency, and the numbers that have always been on the page, when you have a down cycle is when these things tend to metastasize.
All right, you've been listening to David Einhorn, of course, of Greenlight Capital, live from the Robinhood Conference in New York City, sitting down in a live interview, a Bloomberg exclusive on radio, TV, and YouTube with Bloomberg's Sonali Basak. And I think what I really took away, this is a guy who has looked for value plays, right, and opportunities, if you will, and he says there's very few of us left, but he also went on to say that he's not sure if value investing ever comes back. And I thought what was interesting too, Tim, is he says nobody knows what anything is worth. We are looking at the market environment, still unsure and uncertain about the future, and so how do you make the correct valuation calls?
A lot of it has to do with discount rate and, of course, with interest rates. So how do you value something if you are unclear with how far rates are going to have to climb?
Correct, right? And how persistent inflation is. He also said systemic risks have built up in global bond markets. So many of the conversations when we talk with investors, especially people like David Einhorn, it's basically what are the risks that are out there? What is it that we might be missing? What's the next crisis? And many would say it's not going to be like the financial crisis that we saw, the housing mortgage meltdown. It's not like the tech bubble, probably something else.
He also said the Fed got a slow start when it came to fighting inflation. Sonali Basak there, referencing comments that he's made, about 25 basis point hikes. He said that was akin to using an ice cream scooper to clear a driveway of snow.
Yeah, I mean, it's tricky. And this is something we just talked about with Christine Harper about Jay Powell needing to stay the course, just like Paul Volcker back in the 1970s. It's not easy. This is Bloomberg Radio.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
We are counting you down to the close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs. Still with us now are our colleagues, Carol Massa, Tim Stenovic. We together welcome across our audiences, TV, radio, YouTube, to dissect what is a market that turns once again lower, and it is big tech in the line of fire, Carol.
Yeah, absolutely. We are well off our best levels of the day. We were seeing a positive tone, but certainly very different. We've just got a slight gain on the Dow Jones Industrial Average. I mean, one of the sectors I was keeping a watch on was biotech, which seemed to have some outperformance even when we were up on the day, up more than 2%. But we're seeing even that group, which so many names continue to be in the news, and we've seen quite a run outperformance in the market overall for biotechs versus the major market averages. But right now, Tim, that index too is flat and just a little bit lower.
We're actually seeing some underperformance when it comes to casinos with exposure to Macau, specifically Wynn Resorts and Casinos, Las Vegas Sands, both down about 8% right now. This comes after a day yesterday where we got weak spending data during China's Golden Week holiday, and then today that commentary from the IMF that warned of a worsening outlook for the global economy, not helping things either.
And it does seem to be a global narrative that pushes us lower. Maybe some of those words coming from Andrew Bailey of the Bank of England just adding to the selling pressure as we see the NASDAQ now off by 1.34%, 140 points lower. We're currently seeing, of course, the likes of the Russell 2000 also under pressure by 0.5%. The S&P turned negative just at those moments that we heard from BOE. They're down by really 0.75%. Still just the Dow that clings to the green, but only by 21 points, Taylor.
You see a similar sort of narrative on an individual sector level, getting less green. Romain, now only just a few sectors here in the green. Really, staples, real estate, healthcare leading the way as some of the more defensive in nature. Otherwise, all the way down on the screen, it really has been a story of financials and tech that's consistently under pressure. Technology is off now an additional 2% today. You now have about a 5-day losing streak in the NASDAQ 100. That's the longest streak that we've seen this year.
And you have to ask yourself about the importance of what's going on in the semiconductor space here as we see that group down once again. Taiwan Semi now down for a fourth straight day, down 7% here on the day. And that's the story for a lot of the chip equipment makers, primarily like KLA as well as Lam Research. We should point out some companies like Micron, Western Digital holding up a little bit better as they have a little bit less exposure to some of those regulatory and restrictions that could be coming down the pipe from the Biden administration. Speaking of which, keep an eye on Uber and Lyft. Uber shares down 10% on the back of that Labor Department finally putting out some clarity, some rules, proposed rules, we should say, for how we classify gig workers. Meanwhile, Meta Platforms down 4% on the day, down at its lowest level since 2018. And if you're looking for a bright spot out there, it continues to be in the M&A space. Joby Aviation up about 6.5%. This is going to be these little helicopter taxi things that'll lift off and take you to the airport instead of just taking a cab or something. Well, Delta Airlines is taking a stake in the company. Pretty significant deal.
It's like a parade.
Yeah.
We'll be hearing much more, of course, Delta earnings coming tomorrow. I think, though, the market made a turn at 2:38, basically, when we started to hear from the governor of the Bank of England, Andrew Bailey, urging investors, basically, that they've got to finish winding up their positions. They can't maintain them in the bond market at the moment. The central bank is saying, look, we will no longer be intervening in this market by the end of this week. You have got 3 days, he said, basically, to the pension community over in the UK. The financial stability, of course, is one that we worry about. The talk of going through windshields has been one that we've heard uttered from El Arian today, and, of course, Bob Michael at JP Morgan. We want to go, therefore, to our Bloomberg International Economics and Policy correspondent, Michael McKee, who is keeping abreast of what's happening from the IIF, an event where Andrew Bailey was speaking in Washington, and clearly he's unnerved the markets.
Yes, and I think that may have been his goal. I sat in on the speech by Andrew Bailey, the appearance, and he spent a lot of time defending the bank's decision to get involved. But again, as you mentioned, made it clear that the bank has now given the pension funds who had duration problems with long-dated paper and with shorter-dated paper, inflation-linked, that they need to clear that up by the end of the week because the bank says it will get out of the business. Interesting reaction in the markets as gilts stay lower, the yield stays lower, but the pound falls over, as your chart showed, and it does suggest that there's some disagreement about whether or not they'll be able to do this. Andrew Bailey saying that the bank got involved because the markets were so volatile. He said much more volatile than in any of the stress tests that his predecessor, Mark Carney, had designed. He said there's a time when banks have to get involved because they have a financial stability mandate. Back in March of 2020, it was financial stability, but it was also monetary policy because the economies of Great Britain and the rest of the world were going down because of COVID. This time he said they're going in opposite directions, and the bank has to intervene to keep financial markets from melting down.
Yeah, I feel like I've certainly seen this playbook and heard it before, Mike, like as you just referenced in terms of the financial crisis. This is the sticky place, though, right, that global central banks, like we're seeing over in England, find themselves in. Market stability, but also having to pursue a certain kind of global monetary policy in order to bring down inflation. I mean, this is what's at odds right now.
That's why they want to get out of it, because they're working at odds with each other. They're at one point trying to tighten policy, and another they're loosening it, at least for those in a certain space. And they don't want to be in that business, but that's the problem that all central banks are going to face. We don't know what, as one newspaper article said today, what bodies are going to float to the surface as all central banks start to tighten. And so there may be others who have to intervene, at least on a short-term basis, to keep trades going through.
Yeah, and it'll be interesting to see what happens come Friday. Of course, already seen some of the damage, minor damage though, when it comes to the pound today, as well as those gilts. We'll see if we get back over that 5% threshold that we were at just, I don't know, what was it, 3 weeks ago? Bloomberg's Michael McKee down in Washington going to be keeping an eye on that. And guys, this gets us back here to some of those broader macro, and I guess, if I can dare say this, some of the potential systemic issues that central bankers now have to keep their eye on.
Talking about forces at odds with each other, at least you have a Federal Reserve here trying to be consistent with their messaging. There was never a pivot. We are hawkish. We're tackling inflation. And that really pushes us forward to the big inflationary print that we're going to be expecting as well in just a few days. Interesting, some of the comments that we heard from the IMF saying it's not going anywhere down to 2% globally, at least anytime soon.
Yeah, and that the worst is yet to come as well. I mean, that's a serious concern. But, you know, Caroline, we don't always have a perfect track record with the way that the IMF is able to sort of forecast this stuff. So investors certainly keeping that in mind as well.
I mean, the IMF has been pointing the finger long and hard at the UK in terms of fiscal not working hand in hand with monetary policy at the moment. And of course, that odds being shown clearly. We also, though, have the inflation print, but not, also how strong the consumer remains. In the US, you've got the best dirty shirt, really, at the moment. It's the rest of the world that is having to absorb the shock of a stronger US dollar and indeed the bond seller.
And just going back to Sonali's interview with David Einhorn over at Greenlight, nobody knows what anything is worth. And this is the tricky part in this environment. We really don't know a lot about how long we stay at these levels, how long these global central banks have to raise rates, and it's very tricky when it comes to really getting the correct valuations at this point. All right, folks, a lot going on. It's only Tuesday. We're going to be back. We're going to count you down to the closing bell, our cross-platform coverage, our simulcast on radio, TV, and YouTube. We will count you down to the close on this Tuesday.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody, just a reminder of where we are in terms of the equity markets. As we mentioned, the head of the Bank of England, Governor Bailey, saying that intervention markets will be temporary, giving people a few days, 3 days, I believe, to be exact, that there will be a change once again in policy and that intervention will come to an end. In the meantime, we have definitely seen it play out in the U.S. markets. If you ever wondered whether or not we are all globally connected, we certainly are, because stocks have almost moved back to their lows of the session, down the most on a percentage basis when it comes to the NASDAQ, which is down 1.4%.
Yeah, 2:43 p.m., 2:43 Wall Street time this afternoon is when the S&P 500 started moving lower. I would have said it was searching for direction for much of the day today until that point, Carol, but we are firmly not at lows of the day, but getting close there, down about 0.9% of 1% on the
and
S&P.
A lot more momentum behind taking on some risk, and that's what we saw prior to this news. And we also did see the VIX pop, the volatility index, going as high as 34, just above it, so up about 1.5 points as we sit right now. So we saw a pop on that news as well. But this is, you know, again, we talk about the macroeconomic things and the things that just keeping at us. And I thought Mike was, you know, really smart in saying that, you know, in terms of policy, it has to be clear. It can't be at odds with one another, because the really global mission right now is to get inflation down.
Yeah, it's not just a U.S. problem. We're going to get those numbers from in the U.S. on Thursday. 8.1% is what's expected on a CPI.
It'll still be high, though.
Still high, and still high around the world as well.
All right, right now, back to World and National News. For that, it's over to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. The U.S. is speaking out against the latest Russian barrage of missile attacks on Ukraine, with the State Department's Ned Price saying Russian President Vladimir Putin has demonstrated how low he will sink.
We've always said this is a brutal war of aggression, and these strikes seem to suggest that brutality and brutality alone is the point.
Ned Price says Putin is the only person who can end this invasion, and he adds the core principles of the UN Charter are at stake. Senate Foreign Relations Chairman Bob Menendez is calling for a freeze on U.S. relations with Saudi Arabia after OPEC's agreement to cut oil production by 2 million barrels a day. We get more on that from Bloomberg's Joe Matthew in Washington.
The Senate is not in session right now, and I don't know how much more is going to come from this than messaging, but he does suggest, as many have, that the Saudis are helping to underwrite Russia's war by maintaining the price of oil.
Bloomberg's Joe Matthew reports Menendez believes Saudi Arabia needs to reassess its relationship with Russia in respect to the war. Protests within Iran's oil industry are picking up after refinery workers joined the protest yesterday over the death of a 22-year-old woman, Mahsa Amini. Amini, who died in custody at the hands of the country's morality police in Tehran, has been at the center of the strikes as videos circulate around social media portraying her face on signs. While the MLB playoffs are underway and the Phillies lead the Braves 6-1 in the NLDS game, the Mariners and the Astros begin the ALDS game within the hour. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy, thank you so much. Nancy Lyons in D.C. with that World and National News update. A lot going on that we're all trying to keep track of, and that includes watching very closely what's going on with the housing market. Keep in mind, tomorrow we get a read on MBA mortgage applications, but we know these numbers have been slowing.
Yeah, they have, and that slowdown slamming flippers that are hit by a sudden turn when it comes to U.S. prices. This story by Prashant Gopal, who covers real estate here for us at Bloomberg. After an abrupt end to the U.S. housing boom, home flippers who were winning just big months ago are now racing to stem the losses. The doubling of mortgage rates since January has just crushed buyer demand. We're at close to 7% right now, Carol. And depressed values in investors' most favored locations, from Phoenix to Las Vegas to Jacksonville, Florida. This is a swift turnabout for flippers, such as Tammy Morell, who stuck with homes to sell and loans to pay. Here's what Tammy said, quote, "It's a high-risk, high-reward business, and now we're facing the high risk. I'm just praying for a break even." This is a full-time flipper in Denver, Colorado.
Yeah, this is interesting. So America's housing slowdown, as Prashant reports, is upending the real estate industry and chilling sales as both buyers and sellers pull back. It's a particularly big blow to flippers, from property rookies to giant iBuyers like Open Door Technologies, who are taking losses on quick deals in hopes of heading off problems before they get worse. Home flipping activity, it reached a record at the start of the year, making up 1 in 10 transactions, surpassing the levels in the last bubble. This is according to those folks that Prashant talked to, which track sales of properties that previously sold within the last 12 months. While the share remains elevated, it fell to 8.2% in the second quarter.
Well, let's talk even then, because now, compared to the second quarter, conditions have deteriorated even more. Mortgage rates are near the highest level in 15 years. Demand is cooled, particularly in fast Sunbelt markets like Phoenix, Jacksonville, Atlanta, and more. Pandemic boom areas where affordability has been strained. So flippers make about 14% of transactions, Carol, in those regions in the second quarter, but those shares sank. That share sank in July and August.
So you've heard it from us before, you've heard it from our guests, that when you think about the Fed raising rates, we have already seen the impact on the housing market in a big way, and that already has slowed down significantly, including bringing some pricing down. This is Bloomberg.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Those earlier gains for the stock market, that afternoon rally, now has completely evaporated. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. Stocks with a late in the day fade, helped by comments from the Bank of England giving pension funds a deadline. The Dow is now down 23 points, was up 405. S&P's dropped 33, and NASDAQ is lower by 1.5%. The U.S. 10-year yield at 3.93%. Gold is down 2. Energy is in the red, and Bitcoin is down by 1.3%. Among the main 11 S&P sectors, only staples, real estate, and healthcare were in the green. Tech was under pressure, and leaders to the upside in the Dow, Amgen and Walmart, while Salesforce and J.P. Morgan led to the downside. In other news, Credit Suisse faces a U.S. tax probe, and the IMF cut 2023 world GDP outlook, warned the worst is yet to come. Wrapping things up, Fed's Messer says a persistent high inflation shows the need for further hikes. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill Maloney. He's got us covered, and to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, got a question for you, world. What if everything goes wrong at the same time? Could it all get worse, maybe even a lot worse?
It's a good question that we should ask our next guest.
Yeah, exactly.
Fortunately, he's with us.
And he's done a lot of analysis along with Bloomberg team. We're talking about Bloomberg Economics Chief Economist Tom Orlik. He is on the phone from our Washington, D.C. bureau. I feel like such a relevant question to be asking on this day. We know we've got a lot of folks meeting in Washington, finance chiefs around the world. So tell us about what you and various Bloomberg teams, Tom, set out to do.
So 2022 has not been a great year for the global economy, Carol. We've had Russia's invasion of Ukraine. We've had China locking down. We've had the Federal Reserve hiking interest rates. And the outlook for 2023 isn't great either. The lagged impact of a bunch of those shocks is still going to be playing out. So even the baseline forecast for 2023 is pretty pessimistic. Still, the lesson of the last few years is things can always get worse. So at the danger of confirming everyone's view that economics really is the dismal science, Bloomberg Economics have got together and assembled kind of downside risks for the US, China, and the Euro area, and then added them up to come to a downside scenario for global growth in 2023. And what that's telling us is, well, even on the base case, growth in the next year is going to slow to around 2.5%. But if all the downside risks hit at the same time, we could be looking at a global economy going into recession.
Tom, is there any good news in this analysis? I mean, or is it just a dismal science?
So, here's what the downside looks like. The downside is Fed tightening tips the U.S. into a recession starting at the end of this year. Europe has a cold winter, a deeper energy crunch, and a more painful recession. And China has more COVID outbreaks and a more painful correction in its property sector. And all of these things happening together could tip global growth next year down to minus 0.5%, cost the global economy about $5 trillion. So that's the downside. Now, what does the upside look like? Well, think about all of those shocks in reverse. Think about a Fed which achieves the fabled soft landing, controlling inflation without triggering a recession. Think about Europe having a warmer winter than expected, less demand for gas prices come down, maybe Europe dodges a recession. And think about a China that gets lucky and manages to escape from COVID-0 without major outbreaks, without major lockdowns. That's the potential upside. If that happens, we'd see stronger growth. And I think for Bloomberg clients as well, we'd be looking at markets being a lot more cheerful.
All right, I'm going to take off my rose-colored glasses because while I would love to think that all of that can happen, I'm not usually a pessimist, but it just seems tricky. And I guess it's interesting, Tom, to be talking about you and your story and the team story on a day where we just heard from the Bank of England Governor Bailey, saying the intervention to end at the end of this week. It's just a reminder that stuff's going to happen. It took the U.S. market down. Things are coming at us constantly as global central banks really struggle with bringing down global inflationary pressures, at the same time probably at the risk of economic growth. It's just not easy right now. We're also trying to manage financial stability in the markets, but at the same time having to be on that mission of bringing down inflation. It's not easy.
Yeah, I think that's completely right, Carol. And I think one thing which kind of forecasts for the future tend to assume is that policy is perfectly executed, right? Fiscal policy gets it right. Monetary policy gets it right. But we're in this really extreme situation right now where getting it right is actually pretty hard to do. And we saw the UK making this big unforced error with Chancellor Kwasi Kwarteng sort of losing the confidence of the market and triggering that big move in the pound and the big move in the gilts market. And we saw the Bank of England coming in and say, okay, this is an emergency. We're going to step in and head off risks to financial stability. And then today, Bailey saying, yeah, we stepped in to avoid a crisis, but guess what? That support is time limited, and that now tipping the market into a fresh downturn. And I think all of that just illustrates the fact that getting policy right in this extremely stressful situation when inflation is too high and growth is too weak is tough to do.
Hey, Tom, markets, as you know, price in what's coming. And I'm wondering, in your interpretation, I know you're an economist and you're not focused on the markets necessarily, but what's your interpretation of what markets have priced in right now?
So, I think one of the concerns for the markets right now is that they can't see what the bottom is, right? Mm-hmm. They know there's more Fed tightening coming, but they don't know how high the Fed is going to go. They know that Europe has a painful winter ahead, but until they can see what the weather's going to be like and how Russia's going to behave on gas supply, they don't know how painful it's going to be. And they know China has this really difficult adjustment ahead as they exit from COVID zero, but they don't have visibility on it, right? And I think all of these uncertainties are weighing on the market. So an additional potential upside for the year ahead from a market perspective, if not from an economic perspective, is we see the depth of the problem, right? We have a clear view on where the bottom is.
Right.
And once we have that clear view, the markets don't have to price in extreme downside scenarios. That could be a trigger for a bit more risk on.
Tom Orlik, thank you so much. The perfect interview and the perfect voice on this Tuesday.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You know what's tougher than being maybe a central banker?
No, what?
Actually,
I don't know what's tougher.
I don't know
What
that
were you
anything-
going to say?
I don't know where I was going to go, but you know what's tough today? To be an investor in Uber and Lyft.
I think it's tougher to be
Sorry,
a central
that wasn't
banker.
good.
There are a lot fewer central bankers than there are investors in gig economy companies.
That is
I
true.
see what you were doing, though. It kind of worked.
I was trying.
I'm trying to help you out here.
Need to have something. I don't know.
Can
Gotta
Charlie
work on that.
Pellet help us out?
Always,
Okay,
always.
let's get over to
Here we go. I'm keeping a track of both Uber and Lyft based in San Francisco. Shares in both companies are plunging, down 11.4%. Lyft right now down by 12.8%. We'll tell you why coming up in just a moment. The Dow, the S&P, NASDAQ, all in the red right now. 28 minutes to go ahead of the closing bell, with the S&P now down by 33 points, down 0.9%. A few minutes ago, making another run for the worst level of the day, which would be a drop of 1.2%. Bottom line here, stocks are falling in a choppy session that saw the benchmark bounce between gains and losses after dropping to the lowest intraday level since 2020. So to be sure, we've got the S&P down now by 1%. Year to date, the S&P is down by 24.9%. The Dow down 41, down 1/10. NASDAQ down 167, down 1.6%. 10-year yield 3.92%. Spot gold down 0.1%, 16.66 the ounce. And West Texas Intermediate crude now down 3%, 88.35 a barrel. The drubbing in Cathie Wood's flagship exchange-traded fund threatens to take out its low reached during the depths of the pandemic. The $7.1 billion ARK Innovation ETF extending a 3-day slide to about 11%. Bloomberg Radio caught up with Wood this morning at the Greenwich Economic Forum.
You know, algorithms are dominating the market. You know, it's very interesting. Most people don't know what our companies do, and they don't know the kinds of problems they are solving. But as we've gone through this period, this 75% decline, we've concentrated from 58 names to 33 names, to our highest conviction names. Typically, that's a very good strategy for the turn in the market.
And meanwhile, her ARK ETF, ARKK, on the ticker, down now by 3%. Semiconductor stocks moving lower again today. AMD case in point down 1.2%, Intel down 1.3%, NVIDIA down 1.5%. Recapping, Uber, Lyft, both selling off. 11% drop for Uber, Lyft down 12.7%. And that is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that setup. As we just heard from Charlie, Uber and Lyft tumbling today after the Biden administration issued that proposal for a federal rule that would change the way it approaches workers' employment status. It's a move that could upend the ride-hailing companies' business models since, as you know, they rely on millions of gig workers.
I mean, it's pretty incredible to see the way that these shares, the companies are moving. Worth repeating these numbers. Uber down more than 11%. We got Lyft down more than 12%
They
right
your
now.
decliners?
DoorDash is down as well. Lyft is my decliner.
Yeah.
That's what I chose. But DoorDash and Uber are down just the same.
Yeah.
Jackie DeValos is technology reporter for Bloomberg News. She joins us on the phone from Washington, D.C. Jackie, why did this news catch investors so off guard?
You know, I think that it was a long time coming. Even companies themselves said they were expecting this proposal to come out from the administration's first day in power. And so I think investors are really starting to grapple with what a gig worker-friendly administration will really mean in practice. And this proposal is kind of the first start of that, even though it was on companies' radars, labor activists' radars. It doesn't substantially change the way companies operate in the immediate term, but just the risk that it poses for their business models is still very much lingering, which is why you're seeing shares fall so much today.
You know, it's so funny. I keep going back to this comment that David Einhorn of Greenlight said that, you know, we really don't know what anything is worth. And he was really putting that against, you know, investments against kind of the big macro stories that are out there. But you take it something like Lyft and Uber or anybody else who's part of this gig economy, what does it, a gig, right? You take a gig and you do other things. That's what it's all about. But you do have to think that if these workers are classified as regular workers with all the benefits costs that come along with it, that's increased costs for the company, and it's going to change how they are valued. It will have to.
It has to. And, the argument that companies and labor activists have actually made is that, the way we classify employees is rooted in a law that just doesn't account for the rise of digital work. These laws were made, in a post-World War II era, not when, you're ordering food and hailing a ride just from your phone. And so the landscape has totally changed. You're absolutely right, Carolyn, that everyone in some capacity has a connection to gig work, whether you're the one ordering or you're the one actually delivering something to someone's doorstep. So this rule, I think, is the first step in which the administration is really looking to broaden that definition. There's not a whole ton of guidance that we have on, will companies eventually have to fully reclassify? But, Uber has a little bit of experience in that, they had to do something similar in London. A Supreme Court ruling basically said that their drivers were full-time employees and had to be given certain benefits and wage protections. The company didn't tumble, it's still alive. And so what a lot of legal experts are saying now is that, this is really going to be hashed out more so in the courts, where this rule is now going to be the interpretation and the basis which, that labor law is then applied.
What I find so incredible about the Uber and Lyft story is they entered these markets as disruptors, and in many places, including New York City, just decimated the incumbents, the taxi industry. Now we're at a place, and I think anyone who's tried to take an Uber or Lyft from the airport recognizes this, where you're getting into one of these cars to get back from the airport. It's costing so much more than it ended up costing a yellow cab. If you were to take a yellow cab, but you can't get a yellow cab these days because, those drivers aren't necessarily around.
Yeah.
Jackie, talk a little bit about the way the landscape has changed and what ends up happening here, because it does seem like at the end of the day, the way that companies are able to pay for this is through higher fares.
Absolutely. And that's exactly what, the industry groups who don't want a change will tell you, that, we should keep things the way they are, because then it means that consumers will bear the cost. And, while that might be kind of the extreme version, it's certainly going to be, part of the reality. When you think about, the protections that and the benefits that any employee has, whether it's, a sick day or workers' compensation, a lot of these drivers have to put themselves sometimes in harm's way without, knowing that that's what they're signing up for. And that's kind of this debate now. It's not going to be one or the other. It's going to be some kind of hybrid, and investors are kind of pricing that in. Companies as well. I think Uber has kind of come out at the forefront of this now that they've had to contend with this in Europe, that, they're open to what they call an independent contractor plus model. So we may not, have you be full-time employees, but hey, we'll throw some benefits your way.
Yeah, this is like innovation disruption bumping up against kind of the established models. We'll see how it plays out. Jackie Davalos, technology reporter at Bloomberg News. Both Uber and Lyft selling off, though, in a big way today.
Well, let's stay in Washington and get to world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. Group of 7 leaders say they will stand firmly with Ukraine for as long as it takes to defeat Russia. Their declaration comes after a second straight day of Russian missile attacks in Ukraine. The Kremlin struck the cities of Zaporizhia and Lviv after one of the most intense barrages across Ukraine since the war began. We get more from Bloomberg's Rosalind Matheson.
The message that we're getting from Russia as this war takes an even darker turn is that Vladimir Putin is not going to give up. He's not willing to cede the ground, even as his troops struggle to retain territory.
Bloomberg's Roz Matheson. NASA Administrator Bill Nelson says after looking at all the evidence, the space agency believes the DART spacecraft was successful in its mission to change the orbit of an asteroid's moon by crashing into it.
The team has confirmed that the spacecraft's impact altered Dimorphos orbit around Didymos by 32 minutes.
Nelson says that's far better than the 10-minute change they'd anticipated. Millions of pigs held in pig farms across the country were in the spotlight today at the Supreme Court. The justices heard oral arguments in the case targeting California's Proposition 12, which, if upheld, would ban the sale of all pork from mother pigs housed in cages or crowded group pens with less than 24 square feet each. According to the National Pork Producers Council, most typical pig farms would fail to meet those standards. In the MLB playoffs, the Phillies lead the Braves 7-3. No score yet in the game between the Mariners and Texans. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
All right, Nance, thank you so much. Did I hear right? Pigs at the Supreme Court?
Yeah, that's right.
Okay.
Yeah. It's a big story, Carol.
Yeah, no, I know. I think they were talking about it in the control room. Not control room, but in the newsroom today. Yeah.
It's...
Yeah.
There are a lot of issues out there today.
There are, all levels.
Yes.
Everywhere you look, up, down, east, west, north, south. Okay, having said that, talk about issues. Someone who's been dealing with lots of issues is the company Peloton and its former CEO, John Foley, also co-founder of the company.
Yeah, really incredible story in Dow Jones today. When I crossed the Bloomberg terminal earlier today, Carol, I thought to myself, this is one we are going to talk about. And then you, of course, sent that email later.
It was like a dog with a bone, wasn't I?
Yeah,
today?
you were. Anything Peloton related is you love. I mean, it's because you have a Peloton.
I do, but I also, when out of the gate, everybody's been talking about it. Then it just took off, obviously, during the pandemic, right? Unbelievable.
Do you
and then it's come
use
down
it still,
a lot.
or do you hang clothes on it?
I don't use it enough, according to my husband. Not complaining about me, just saying, why do we have this?
Do you still pay for it every month, though?
Yes, I
yeah,
do.
so that's fine. You don't really affect the company. You're
No,
still
I'm
paying
helping
for it.
their top and bottom line. So this story by Dow Jones, Wall Street Journal, well reported, or at least an interesting read, that's for sure. John Foley, the co-founder, former CEO of Peloton, faced repeated margin calls on money that he borrowed against his Peloton holdings before he left the fitness company's board last month. This is according to people familiar with the situation. Peloton shares, by the way, down about 5% today.
So as Peloton shares slumped over the past year, Goldman Sachs asked Mr. Foley several times to provide fresh funds or additional collateral for personal loans the bank had extended to him. This, according to the people that Dow Jones spoke to. The company's share price has fallen nearly 95% from its $160 peak that was back in December of 2020.
It right now trades below $9 a share. Resigning from the board gave John Foley flexibility to sell or pledge more Peloton shares, though he said the margin calls weren't the reason he left the company. I didn't resign from the board because I was underwater, he said. To the extent that I took on debt through Goldman, it was because I am bullish on Peloton and still am. It was and is a great company. You can read more. You can find this story on the Bloomberg Terminal.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pettit. We've got the Dow higher, the S&P, NASDAQ both on the minus side. Choppy session today with the S&P down 25, lower now by 0.7%. Stocks turning lower, late trading after comments by the Bank of England chief on removing market support. That rattled investor sentiment. Again, the S&P down 25, now down 0.7%. NASDAQ down 127, a decline there of 1.2%. The Dow up 45 points. That is a gain of about 0.2%. Your 10-year yield right now, 3.92%. We've got the 2-year yielding 4.30%. Spot gold down 0.1%, $16.66 the ounce, while West Texas Intermediate crude is down 2.7%, $88.64 a barrel. Bitcoin down 1.3%, 19,000 even right now on Bitcoin. So again, recapping, stocks turning lower with the S&P down 23, drop there of 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. It is 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Climate change is adding to the danger of severe storms, as Hurricane Ian in Florida recently made clear. Yet America's current approach to flood insurance discourages responsible choices about what gets built and where. When the hybrid public and private insurance market meets current disaster relief policy, the result is mispriced risk, misallocated investment, and a mounting toll of suffering and cost. In essence, the government is subsidizing people to live places that put them in danger. It's time for a rethink. After climate-related disasters strike, getting back to normal should no longer be the overriding goal. Help the victims, to be sure, but take action so that next time there will be fewer of them. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about under 10 minutes left in today's trading session, and another volatile day bouncing around. We're certainly off our highs and lows of the session. Those Bank of England governor comments, Mr. Bailey, that certainly has put some pressure on the trade today, and we saw market reaction. We've got a great guest actually in studio. It has been a long time since we've had him in studio here.
Can't believe this is the first time I've gotten to meet him in person in 2 years doing this. Doug Ramsey is Chief Investment Officer at the Luthold Group. He joins us right now in the Bloomberg Interactive Broker Studios. Doug, good to have you with us. Is this your first time back to the city since the pandemic?
I was here end of February 2020, just as things were starting to erupt.
Welcome back. It's good to
Great
have
to
you.
be back.
It's good to have
great
you back
vibe in the
with us.
city. Great vibe here in the Bloomberg building as well.
Not a great vibe in the markets.
No. Well, it depends on your perspective. I mean, opportunities are being created here for flexible managers.
Well, what does that mean? So say, I agree, right? Like when everybody's running for the exits, that's when you find opportunities. Much smarter investors than me have said that. And, you're saying it too. So are you saying that we're near a bottom when it comes to the equity dropout, or no, but even the selling so far provides some great opportunities?
No, I think there's a ways to go, but I mean, the valuations are far better than they were coming into this year. That's especially true for mid and small company stocks. We track valuations across the landscape and globally, but mid caps and small caps are now somewhat below their long-term valuation averages, and we haven't been able to say that for quite a while. So that's encouraging. So I think there's a buying opportunity that is developing. It's not yet there. I mean, if we are going to get one in valuation terms on large caps, we've still got some distance to go. And that's normally the way things unfold in a bear market is large caps have better liquidity. They tend to be more defensive in nature.
Right.
They are really the last to fall in a cyclical bear market. And I still think we have that phase ahead of us. But I am encouraged by some of the valuations I see in pockets of the market for a later buying opportunity.
What about when it comes to the large caps? When do you think we'll get to a buying opportunity for those?
I don't like to get too focused in really either on time horizon or price levels. I mean, I do think what's going to evolve over the next several months is we'll have the best buying opportunity we've had in the stock market for over a decade. I mean, not back to 2009 levels, but I think it will be a very good buying opportunity. But just in terms of numbers, and again, I mean, it's well known that valuations are not a timing tool.
Right.
But just for some perspective, if we were to put in a bear market low that matched the valuations we saw in March of 2020,
right,
which was by far the most expensive bear market low in terms of valuations, we'd still have to sink to 2,900 in the S&P 500. And again, I don't want to get too locked into price levels here because
right now PE on the S&P 500 is about 17 or about 17.5. So still high-ish?
Well, we look at, I mean, we certainly look at forward PEs, but the 2,900 was really referring to like the average of multiple different valuation statistics. And we do something akin to what Robert Shiller does with the 10-year PE. We've been doing it for decades, using 5-year normalized earnings. I'm just adjusting for the fact that earnings dramatically can overshoot as they did in 2021, and then they get crushed during recessions. Let's just try to see through that by smoothing out earnings for the cyclicality of that earnings can have. So on that basis, yeah, we'd have to drop our multiple on the basis of normalized earnings is still around 23.
That's a pretty big drop from here.
Yeah, well, you'd have to go from 23 to 18 to match, again, what will be the highest valuation we've ever seen. And then we supplement that with work on, you know, the price to sales ratio, price to cash flow.
Is there anything different about this market environment other than we're coming out of a pandemic that none of us have lived through before? Like, is there something, you know, the old adage, you know, it's different this time around or it's not different this time around. Is there something different about this market environment, though?
Well, I mean, the abrupt change in not just monetary policy, but also in fiscal. I mean, just the delta versus a year ago. I mean, we blew out the trailing 12-month federal deficit to as high as 18% of GDP. Now it's about 4%. And, you know, we all talk about QT and the rate hikes, but the degree of swing in fiscal stimulus has been every bit as great.
So, Doug, in terms of the way we're thinking about this moving forward and the Federal Reserve's role here, how are you looking at the terminal rate? How are you thinking about what the Fed is doing when it comes to tightening in the context of the investment decisions that you're making?
We don't necessarily have a forecast, I guess, for where that funds rate might peak. I mean, we are assuming they've already overdone it. And it's the emphasis, they are data dependent. The question is, are they the right data points? I mean, they are coincident to lagging data points. I mean, our work would say that inflation has probably peaked out. The leading inflation indicators.
Is this why you say Powell doesn't need to be Volcker?
There are a number of reasons. Well, along those lines, and this is maybe, I mean, in
fits
terms
in with that discussion we just
I'm
had.
trying to take some good notes here about what
I know.
Doug is talking
He's
about.
killing me.
Well,
This is some good stuff, Carol. That's what they say in the biz. This is some good stuff.
You know, even though we're cautious on the stock market and the economy, we do think that inflation's peaked and is going to come down significantly. One reason is the stock market itself. It's the negative wealth effect, and Bill Dudley in the spring came very close to like mentioning that term exactly. It's the fact that, you know, we've had a 25% stock market decline. The issue is, don't think about it just in terms of the percentage decline in the index. Think about how large the stock market was in relation to GDP at its peak coming into this year. It was more than 200% of GDP. So this relatively moderate decline is a big deal in terms of the wealth destruction.
We never have enough time with you, and I hope you got your notes there, Tim. 20 seconds. So what to you will say we're near bottom? I know you don't really necessarily have a number, but what kind of feel do we have? You have to be quick.
lower valuations, a big relative crack in the blue chips, where small caps and mid caps, they probably still go to new lows, but maybe show some relative strength. So giving and maybe a give up, and then we've seen it in the utilities.
Yeah.
But when you start to see the defensives crack, that's a sign that people are selling what they can, and we may be near a complete capitulation, which I think is still ahead.
Did you get your notes?
Oh, you'll hear in a couple minutes what I have to say.
Yeah, we love talking with you. So come
this is
back
fun.
anytime, on phone, in person's even better, but safe trips back.
Thanks so much.
Doug Ramsey, Chief Investment Officer at the Luthol Group, here in our studio. All right, folks, time to head over to our TV colleagues, our cross-platform coverage, radio, TV, and YouTube. We're counting you down to the close on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. And here to help take us beyond the bell, it's our simulcast with Carol Massar and Tim Stenovic. We welcome our audiences across Bloomberg Television, Bloomberg Radio, as well as on YouTube. Another day here, guys, where we focus on the macro, we focus on financial market stability, and I guess to a certain extent, we focus on the fundamentals. And right now, none of them seem to be looking pretty good.
No, exactly. Certainly feels that way. And talk about bouncing around. And we saw some momentum, certainly, to the downside as a result of the news out of the governor of the Bank of England. But it's just a reminder that stuff comes at us, comes at investors from any perspective and any part of the world. And it's just another reminder that we are certainly global markets and all connected.
We just had a great, go ahead.
No, I'm sorry, Tim. I didn't mean to step on you.
That's okay.
Can't interrupt people on the show, Taylor.
No, very uncouth. Very uncouth.
Excuse me, who just said that?
Hot kettle.
Hot call, yeah, exactly.
All right. We just talked to Doug Ramsey. He was actually in our studio for the first time in, close to 3 years. It was really great to have him join us. And he made some really interesting comments. He said that he assumes the Fed has already overdone it, and that inflation has already peaked, and we'll see it come down significantly. He talked a lot about the negative wealth effect, the idea that people feel less wealthy, so they're going to spend less, and which will, of course, decrease consumption.
I think that's right. I think when you think about sort of big picture, the central banks that are finally trying to test the market and say for the first time really in a decade, Caroline, we're trying to figure out what things are worth. Money isn't free. Nothing is at 0%. There's downside for the first time in a long time. And that's a conundrum that these markets, I think, are trying to get through.
What was it, tiara that Ed Campbell just said? Finally, there is some sort of an
a reasonable, maybe.
Catch a falling knife.
And we talk about here kind of the big volatility that we've seen in this market. The Dow Jones Industrial Average that had been the bright spot on the day. It was up as much as 1.4%. Was going to close today only higher by about 1/10% here on the day. I want to point out, though, the S&P 500 here. We're down about 0.7% to close out the session. Closing in at 3,588. Now, remember, we closed below that 3,600 level back towards the end of September. But I thought it was interesting this morning. This was actually the first day that we actually opened below 3,600 going back to November of 2020. So you talk about the round trip that effectively has been put in place for the S&P 500, as well as the NASDAQ Composite, which is down another percent here on the day, back down to that 10,426 level. You are seeing some activity in some of those cyclical names. The Russell 2000 going to finish the day higher in the green, but only by about 0.1% here on the day. It was much higher earlier, but a lot of those macro concerns really kind of scaring people off.
Yeah, I feel like all over the place in terms of the market moves today. Right now, though, as we settle in, and we're going to talk about major industry groups, the S&P 500, more risk off, 303 names to the downside today, Taylor, 198 lower, 2 unchanged. So definitely, again, a more of a negative tone today.
Yeah, Carol, you see that on a sector level as well. Take a look at where we're on some of the individual sectors here. There's some red, even in the, quote, best performers. For a radio audience, we'll make sure to tweet this out to you. Let's start with the winners. There were some. It was defensive in nature. It was sort of an inflationary hedge in nature. It's food and staples, it's durables, it's real estate, it's food and beverage. Those are sort of the sector winners. Unfortunately, Carol, as you mentioned, there was a lot of red, and the red gets worse, off about 2 to 3%. It's all those long duration assets with yields rising, technology, software, media, semiconductors, auto components. And the banks are down there as well, off about 2.6% ahead of some of those earnings that we're going to get on Friday.
All right, here's to some of the individual gainers, and we've talked about this throughout the day. American Airlines up at almost 6.7% at its highs today, still finishing a gain of about 1.7%, rallying after lifting its third quarter sales above prior guidance. So it's talking about revenue in the period expected to be up about 13% over the same quarter in 2019, slightly better than their prior outlook of no more than a 12% increase. So that was up. Top in the S&P 500 and NASDAQ 100, Micron Technology, despite pressure on the overall semi space, Micron was up about 4.5%. We did see quite a wipeout yesterday following that Friday news of curbs on China's access to semi-technology. So you've got that going on. And then Amgen was up almost 6% today here at the close, top in the S&P and NASDAQ 100. It's a result of a Morgan Stanley upgrade to overweight from equal weight, highlighting the unappreciated upside in the biopharma's midterm pipeline, and the price target raised to $279 from $257. Stock closing at $245 and change today, Tim.
All right, you got the gainers, I got the decliners. Let's start with Microsoft. I picked this one yesterday as well. In the last 4 days, it's actually shed nearly $180 billion in market cap, finishing the day down by 1.7% today. It was the biggest loser in terms of weight on the S&P 500 and on the NASDAQ 100 today. The information technology sector, I should note, down 33% so far this year. It underperforms the nearly 25% decline that we're seeing in the S&P 500. Tesla also weighing on the NASDAQ and the S&P 500, down 2.9% today. It's down for a fifth consecutive day, shed about $100 billion of market cap in that time. There was also this news out. It didn't necessarily move the company's stock that Elon Musk denied a report that said he spoke directly with Vladimir Putin about Ukraine. He did say he last spoke with Putin 18 months ago, and it was not about any sort of war. And then Lyft finishing the day down. Go ahead, Romain.
That's swell.
Yeah, it was. I was surprised to see this. I mean, this is.
Was this during the war?
No,
How long ago was that? That was
18
prior
months
to
ago.
the war? Okay. All right.
Yeah,
Just checking.
The current war. That's the thing to keep in mind. I mean, we know that Russia has annexed other parts of Ukraine and other parts of Ukraine in the past.
Okay. Well, it's good they're in communication.
Yeah. Lyft down 12% today among other gig economy companies. Uber finishing the day down about 10%. DoorDash also falling. The Biden administration issuing a proposal for a federal rule that would change the way it approaches workers' employment status. That could really change the way that these companies do business. I was a little surprised that the stocks moved this much on this because we've been talking about this for so long. We saw what happened in California. We saw what happened in the UK. But obviously it caught some investors off guard.
Did you hear the comments from Uber itself, kind of saying this is no big deal? This just kind of takes us back to the Obama administration rules. So
yeah,
even they're saying it's not that big of a deal, but whatever.
We'll see.
Yeah.
Well, it's old again is new again. And let's go back to some of the geopolitical risks that have the market upended at the moment. We had, of course, a bit of a rally in the interim of today. At lunchtime, we got galvanized into thinking that the dollar should perhaps go lower. And in fact, we piled back into some of the more risky assets. But then it all dialed back again, largely in part because of Andrew Bailey, the governor of the Bank of England, coming out and saying, look, you have but 3 days, pension funds, to get your house in order before we stop supporting the bond market. Well, it meant that the British pound sunk by 0.75%. It is weaker versus the US dollar, moved back into the haven that is Bloomberg Dollar Index, that gained some 0.2%. We see across the board the sell-off that goes into the commodity space. That has actually been resolute all day. We are worried more about geopolitical risks, worried about Ukraine and Russia, and indeed that has an impact on the wheat market today. But oil is on the downside as we worry more about those global recession threats, the talk coming from the IMF. WTI off by 1.9% overall. Brent crude was down 2.7%. And in fact, when you see metals that we've been selling off as well. And I look at a sovereign bond market that if the UK had been open, we'd see a big move, I'm sure, in gilts, as we heard from Andrew Bailey after that market had shut. But indeed, we did start to see overall in the day's trade a movement out of certain of the markets. Japanese yields had been pushing higher, so too had Norwegian on the back probably of the oil move, Taylor.
We're seeing a huge sort of inflationary narrative, Caroline, when you think about full faith and credit. Again, another relentless climb higher. It's not the big sort of double-digit moves that we've seen, but you're still getting 6 to 7 basis points across the curve. Carol, we'll take out yesterday, of course, because the bond markets were closed. Outside of that, again, 4 straight days of this move higher. I wonder about the correlation with the NASDAQ that's now been lower for 5 straight days and the impact rising yields again are having on the equity markets.
All right, so now our shift, I guess, is to some of the economic data points coming up. We got PPI tomorrow. We've got the FOMC meeting minutes, and it'll be interesting as we kind of go through those minutes, how we put that against what we've heard from Fed commentary. And I'm thinking about some of the back and forth. You've got Cleveland Fed's Loretta Mester, talking about, a lot more hawkish. You also have, different people saying they're concerned about stress in the financial markets. Others saying, expect some volatility. That's what's going to happen. It's kind of this back and forth, if you will.
Yeah, but I mean, we don't think anything is actually going to change before the next Fed meeting. This is kind of the last most important data point for the Fed. I'm talking about Thursday's CPI report, or the last CPI report that we have before the Fed's meeting on November 2nd. And, you know, everybody's just saying 75 basis points. That's what traders are betting on, and that's seemingly what the Fed speakers are saying.
Well, yeah, and I mean, there's really nothing, I guess, to knock them off that pivot. I mean, you talk about the PPI numbers tomorrow, the idea that, you know, we're going to be, above 8% on the headline, but even on a core basis, above 7%. That's basically what's in the pipeline, presumably coming to consumers, unless, of course, some of these companies want to eat the costs. But how many companies have we already heard basically saying, look, we're raising prices, and at least for now, consumers seem to be taking them. So what does that mean then for the CPI number? It's, you know, as Taylor would say, you know, it's second order, first order, what is it, fifth order effects?
It's the first derivative, second effect.
First derivative. Okay. All right.
And also, well, what is the 17%?
Do you divide that by 6 or 7?
What does
Love
that
you,
mean?
Romaine.
All right. Well, we've got a lot to talk to, and we'll continue tomorrow. All right. Right now, we're going to head back to the annual J.P. Morgan Robinhood Investors Conference. Bloomberg's Sonali Basak sitting by with a key voice. Sonali, over to you.
Thank you, team. Welcome to our Bloomberg television and radio audiences. I'm standing by with Barry Sternlicht. He is the CEO and founder of Starwood Capital Group. And what a time to talk to you at a time of rising interest rates, a lot of jitters in the market. You're here at Robinhood right now. What's the sentiment like? Is it negative? Is it a group of people who are ready to start to dip their toes in the water at a greater rate?
I would say in general, I've been surprised that I wouldn't call it optimism, but there's a weird optimism. There's a group of professional investors or people really interested in the market and ideas, and everybody's looking for things to do, smart things to do. And I think the overall sentiment, everyone's sort of looking at each other and saying everyone is so negative that maybe that's a positive. Like the sentiment is so bad, and even everybody knows the S&P earnings are too high. Everybody knows GDP growth rates estimates for next year are too high. So the question is, when is the market going to say, when is it discounted? When have you sold your securities in anticipation of that happening? And some people say, okay, the bad news, it's going to get worse, and so that's not in the market. Or it's already, everyone understands what we're talking about, and so they're positioning for the inevitable rebound.
Do you have a general consensus on what that capitulation could look like? How much worse it could get before things start to get better?
Like, you know, for me, for value guys that grew up with cash flows and I think value investing, there'll be incredible opportunities. I think what we're looking to do is pick through the debris and find the companies and the investments, in our case, and mostly in real estate, that they're broken balance sheets, but not broken assets. And there'll be broken companies, but I mean, broken balance sheets and companies, too, that represent fantastic opportunities to deploy capital. Taking a medium to long-term view, I think the question for us and for investors is the faster the Fed goes and the more damage they do, probably the faster we wind up having to lower rates when they realize the mistakes they've made. Unfortunately, they're going to cost millions of people their jobs globally, and there's really hurting global trade. And obviously, you see the situation in the UK. People are beginning to talk about Japan, their defense of the yen, and can they do that? I mean, they're putting unprecedented stress on the world. And you know, Powell was unbelievably late doing this. He sat still while the meme stock craze was going on, and I heard about 80% of the ICOs in the crypto world have gone bankrupt, and the Fed was quiet. And now, you know, people got employed. We should be proud of a 3.5% unemployment rate, but they're hell-bent on putting people out of work. And they're really going to lose their jobs because of what they've done already.
Why do you feel that way when there's still such a demand for labor in so many areas, including...
It's rolling over. You know, it's rolling over. So the housing market, construction workers, construction projects, the auto workers, there won't be less demand for cars. You know, I think the Fed is looking in a rearview mirror. You're looking at a lot of information that's old. You just look at what CEOs are reporting and look at what you'll hear in the third quarter earnings reports. You'll hear probably decent earnings in the quarter, but then I think the outlooks will change, the guidance will change, because people are so uncertain, and the currencies are creating quite a bit of volatility. And the interest rate environment means that the project you were gonna do, you might wait for more clarity. Waiting is a recession. And I think, you know, again, I think the question is, how fast will rates have to fall to fix the damage? And if he does too much too soon, he could make it this really bad. And I think you hear that, but I don't know. I mean, it's not our job to be equity market, forecasters, but, I am personally looking for opportunities that I think represent incredibly compelling long-term investments, and I think you're beginning to see them.
Do you think that opportunity and distress in particular is something that is around the corner?
Absolutely. This is a bunch of minefields, right? This is like, you're going to hear about, that's why I'm so agitated about this, because we're creating this collateral damage. And I kind of liken it to there were really smart things people did, and there were healthy fish in the pond, and then these stupid things people did, and they were idiot investments, and for whatever reason they called it the democratization of finance, which means you didn't have any idea what you were doing, but you were taking on professionals that did things like look at the quality of the company or the quality of the management. And so you thought the healthy fish would survive and the sick fish would die, but the Fed is draining the entire pond. So everyone's going to die. And so it's going to happen over time. You'll hear about explosion here, and explosion there, and explosion here, and explosion there, and you're literally stepping into a minefield. And the Fed, what people don't realize is the Fed has frozen the banking system, not just in the US, but globally. So liquidity is drying up in the banks, and then the shadow banks can feast on that, but they're also nervous. So without liquidity in the system, not only are they raising rates, but they're obviously selling bonds at the same time. It's the fastest rise in rates in history. I think I just get angry at people who said the Fed needs credibility to fight inflation. Wait, you'll get what you want. You'll get this recession. It's definitely coming. It's already here, the 2 quarters negative already, but you will see. Look what's happening. Look at Nike. Look at AMD. Look at Target. Look at FedEx. I mean, this isn't your normal market. This isn't like things are running away.
Well, what about, let's we can talk all day about what this means for investors, and we will, but let's talk for a second about what this means for the real economy, because you're in the residential space. We reported a little earlier.
Spaces.
Yeah, you're in all the spaces, and you've sold. We reported that you've been selling earlier this year. What does this mean for residential as opposed to commercial in the next year or so, especially as Americans are already dealing with inflation? Their mortgage rates are going up.
Yeah, and most Americans have fixed rate mortgages, so that's a good news item. They're not going to be squeezed by increasing interest rates, which is actually, I was kind of surprised about that. Most people have fixed rate mortgages. I think it's like 60% of the market. 10% have floating rate, they're going to get hurt, and 30 or 40% of people have no mortgage at all, so they won't really have any impact. But it means people can't move. If you have a fixed rate mortgage and it's at 3%, you're not going to move to a new house with a 7% mortgage, so you're going to be stuck, which is why new home sales are plummeting. I also think people are nervous, or should be nervous about their jobs. One of the funniest things, it's not a funny thing, I just have to say this because I haven't articulated it before, but I think global wealth is down like 36 trillion in the stock market, and I think the US is probably 10. Well, $10 trillion at the lowest capital gains rate was $2 trillion of taxes the government just lost, of revenue. By him raising interest rates how he has, he's cost the US Treasury $2 trillion. At the same time, he's knocked rates up 100 basis points now, 300 basis points off the floor. That's almost $1 trillion of interest expense on $31 trillion of debt. So what are we going to do? We're going to print more money, and that's going to force rates up. So rates are going to drift higher without him having to increase rates any further. And the further he goes, the more money we're going to have to print to pay the interest expense on the existing 31 trillion of debt. So it's really a dangerous game he's playing, and he's killing the economy, and we'll take people out of jobs and we'll put them on unemployment benefits, and then we'll have to give them unemployment benefits when we were taxing their incomes before.
You were talking about corporate balance sheets a little bit earlier. What are you factoring for? Where does the terminal rate really stand for you? And how is that something that you're baking into your future investments here?
Well, let's go back to the real economy for a second, because I kind of lost your question. I mean, the housing market long-term is a very solid market. Both apartments and homes will be fine long-term. We just have to get through this period. Apartments are occupied, rents are healthy, rent growth is still healthy in certain markets. The office markets are the question in the US, but there's still absorption in the office markets. I just returned from a trip to Singapore and Tokyo and Seoul, and everyone's in the office. I mean, they are back full-fledged in the office. This 50% occupancy of offices is really a US thing. And I think it'll change in a slowdown. I think people, CEOs, I was listening to Sam Bankman-Fried earlier, and they're all in the office. They said, how many days a week? He said 6.5. They're like, yes, I like to hear that. But he said, you know, even for him, he said that productivity suffers when the team isn't together, especially doing creative things. And I find that we're all in the office, and I find it, you know, people come voluntarily. I don't have to ask them to come in.
So let's roll back a little bit here, because you were talking about the distressed opportunity, that potentially being right around the corner. Where exactly are you talking about?
Well, in the real estate world, there'll be people having loans coming due that might be hard to refinance. And so they're going to need a capital infusion where they have the money on their own. Strong players like us and Blackstone, Brookfield, you know, we have funds that can pay down debt if we need to save good assets. A lot of people won't have those opportunities. And the banks will probably look at these loans and say, we can either foreclose on these borrowers or we can sell the loan. So I think, and let someone else worry about taking back the asset. The banks aren't in the business of releasing office buildings or repopulating hotels or working on marketing plans. The banks are in so much better condition than they were in 07, 08. My guess is they won't, we called it pretend and extend before. They were allowed to do that in 07, 08. They were allowed to basically not mark down those assets to fair value. The government wanted the banks to be able to recapitalize themselves. And this time, I think the banks will be tougher. And because they're in much better capital positions and they can take the hits. But I think you'll see a lot of loans for being sold. And like I said, it's all the fish. Like it's every asset class. Every asset, there's no asset class in any industry, forget about real estate, that's immune to these much higher rates. And it's not just what the Fed is doing with interest rates, because on top of that, when we borrow at a spread above SOFR, the low rate. And those spreads have more than doubled because of the uncertainty in the market. So a AAA might have priced, let's say, 100 basis point or 1% above the reference rate of LIBOR, the borrowing rate. And today that could be 250. So it's not just the base rate, it's the spread. The total cost of refinancing has gotten pretty expensive.
What about abroad? You started to touch on this a little earlier. The market is really reacting very strongly to what you're seeing happen in the UK, across the world. Yeah. So, you know, you're saying that this is partially the Fed impacting the rest of the world, but there are issues happening elsewhere, and there are really a lot of worries baking about which risk here.
Well, you know, inflation in the U.S., you mentioned labor. Labor is tight, and there's still, even though the number of open jobs dropped to 1.1 million, unprecedented number in the last report, which the Fed should notice, we still have 9 million on the jobs that are not occupied. And part of it's our labor force participation rate has shrunk. But in Europe, inflation is almost 100% the energy situation. And if you could somehow cure that, you talk about an upside. If Putin was kicked out of power and it backfires on him, the markets would have a field day. I mean, Europe would be fine. And the hundreds of billions of dollars they're going to write to their customers and their small businesses and individuals to support their energy bills in this time of crisis across Northern Europe, it's a lot of money they wouldn't have to spend. And it's put enormous pressure on those economies. And you know, our hotels in the UK, the bill was $80,000. This year will be $800,000. We put out for the energy bill, electricity bill. We put out bids for our energy contracts, and 2 of the 7 utilities bid. The other 5 don't even want to play. So in the UK, what they did that precipitated this recent crisis is they put the pedal to the floor on fiscal stimulus by basically saying, we're going to cut taxes. And all of a sudden people say, whoa, we're trying to fight inflation. How could you try to stimulate the economy? So then the banks had to come in and say, support the pound. It's like you're being on the pedal, the brake and the accelerator full out at the same time. And the markets went, whoa, you can't do that. And this is crazy. And it is absolutely insane what they tried to do and their timing of it in the middle of a crisis.
Well, what are the lasting effects of it as somebody who operates in the region?
Well, I mean, so look, one of the most interesting things is how currencies have moved and how it will change flows of capital and how that will affect different asset classes. So for example, the pound at 110 hit, I think, 104. This morning I saw it was 110. Tourism, right? You buy a hotel in the UK, it will be full. Guaranteed there'll be a zillion people there. Americans were all over Europe this summer, and they'll be all over the UK, and they'll not only be staying in hotels, but they'll probably be shopping at all the stores and buying everything. I mean, like, nice time to buy an apartment in the UK. And I think for the people who have all the money today, which typically are the oil-producing nations, really, that have benefited from the rising global prices, and they can go on a global shopping spree. And they probably don't have a lot of competition. There's a lot of money in Asia still, but you know, the American investors, the pension plans here, they're all facing lower, they've lost a lot of money in the stock market and the bond market. So they're not rich as they were. They'll still have contributions, but the real money now is shifted to the Middle East and to some other sovereigns like the new Japanese sovereign.
Now let's come back to the United States for a second, because
Okay.
there's another huge thing just happening really days away, and that's the U.S. midterms. How do you think that's going to change the calculus for investors? What are you watching for? Are there certain areas that you're looking at more than others? How is a second...
A split government right now I think would be good for investors. So if you have the Republicans getting the House, keeping the Senate, or the Democrats taking the Senate and the Republicans taking the House, or the Republicans having a sweep and you have Biden in the White House, a freeze of government doing anything really dumb right now is probably healthy for us to get to the presidential election. So I think the best outcome is probably a split Congress, and maybe they'll compromise and do some smart things and focus on things that matter to the nation instead of some of the nonsense they spend all their time on these days, including energy policy, getting solar. I was listening to a presentation today, Robinhood, about how solar is so powerful as a source and so cheap that energy prices could go to zero. That was actually a presentation by Coatue this morning. Whether it's right or wrong, it's certainly exciting and something the government should definitely put investment behind. Mm-hmm. And they did a little with Biden's Energy Act or renewables bill, which I think he called the deficit reduction bill, which was really clever marketing. But I think those are important things the government can do at times like this. I'm agnostic. I just think we need leadership, and I think it's a very weird time because you have politics, you have geopolitics, you have the economy, you have everything sort of in play at once. You have the China situation, U.S. relations with China, and Biden is certainly up the ante. I mean, he is definitely, whether it's the chips or Taiwan or Pelosi's visit. I mean, you have a lot of things actually that are making investors uncomfortable.
Real quick last question for you here. We've reported this morning that a company that you've backed, SPAC-related company, everyone talks about SPACs as though it's the market that's fully died off. It's in talks with CVS for an acquisition. Has the SPAC market totally failed? Or is it something that you see?
There are a lot of IPOs that were done at the same time as the SPACs were doing their M&A activities. The SPAC, there were some bad actors over buying bad companies. The street was indiscriminate in who they backed. You're talking about Cano Healthcare, which is a real company with $3 billion in revenues and has more than doubled its revenue since we took it public in the SPAC structure. The SPAC in itself was not a bad vehicle, but there were a lot of dumb things that got done. And they threw all the baby out with the bathwater. I have a chart of SPACs on my phone, actually, and I'm watching. Everything's at $2. So some of these are $3. And some of them are really good companies, and they have great prospects. Others are frauds, and they've gone, one of them's at 7 cents, a company I passed at. I think it's 3 cents this morning. So anyway, there are a lot of bad IPOs done at the same time because the banks were trying to compete against these SPACs, and I won't name names, but there are some IPOs done at the same period that are down more than these SPACs.
Well, we will come back to you as we watch you navigate this market. Barry Sternlicht, thank you so much for your time. That is the CEO and founder of Starwood Capital Group. Back to you.
All right, Sonali, of course, Bloomberg, Sonali Basak there with Barry Sternlicht, talking about a lot of things, and you can catch that interview certainly on Bloomberg.com and the Bloomberg Terminal. So much going on today, everyone, and of course, a lot more to come this week. But that's going to do it for our cross-platform coverage on radio, TV, and YouTube. We will see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stenovic. Our thanks to our TV colleagues and, of course, to Sonali Basak. Some great interviews, really getting into the macro issues of our time.
Yeah, really good one. Barry Sternlicht of Starwood Capital Group there as well. Hearing that from live from New York City, really solid. We caught up with Barry at Milken just a few months ago.
Yeah, talked about SPACs, talked about a lot of things.
The market is a lot different than then.
Yeah, absolutely, and more to come. You are listening and watching Bloomberg Radio.
Let's get to Charlie Pellet, who's standing by when it comes to everything happening after the close. Hey, Charlie.
Yeah, well, indeed, a lot going on during the regular session today, Tim. Let's begin with the closing numbers, because we did have the Dow holding on to a 36-point gain today, up by 0.1%. But another losing day for the S&P 500 index. We're keeping track 5 in a row right now on the S&P, down 23, a drop today of 0.6%. Choppy session today. We had NASDAQ down 115 points, a drop of 1.1%. Stocks turned sharply lower in late trading after comments by the Bank of England chief on removing market support, and that rattled investor sentiment. Benchmark Treasury yields rose, the dollar gained. 10-year now yielding 3.93%, the 2-year 4.30%. Spot gold down $1.53, 16.67 the ounce. West Texas Intermediate crude down 2.8%, 88.61 a barrel. Bitcoin 19,029, a drop there of 1.1%. Bottom line, another day of losses for the U.S. stock market. So what about the market backdrop? Doug Ramsey is Chief Investment Officer at the Lutho Group, and he was our guest right here on Bloomberg Business Week.
I do think what's going to evolve over the next several months is we'll have the best buying opportunity we've had in the stock market for over a decade. I mean, not back to 2009 levels, but I think it will be a very good buying opportunity.
American Airlines shares climbed after saying it expected to post third quarter sales above prior guidance, the latest positive sign for the industry after a number of other U.S. carriers credited the surprise strength of post-Labor Day leisure travel and an ongoing recovery in business trips. Today, we had shares of American Airlines, AAL on the ticker, up 1.7%, UAL down 0.8%, Delta dropped 2% today, Southwest down 0.8%, JetBlue down 1.9%. Again, recapping equities traded mixed, with the S&P down 23, lower by 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that market update. Well, just about 1 year ago, the Southern California-inspired activewear brand Vuori got a $400 million investment from SoftBank, giving the company at that time a $4 billion valuation. That brand, founded in 2015 by Joe Kudla.
We got Joe Kudla joining us now, founder and CEO of Vuori, joining us on the phone from New York City, trading one coast for the other coast. Joe, good to have you with us this afternoon. How are you?
I'm doing great. Thank you so much. It's great to be here in New York.
Hey, well, thanks so much for joining us on this. So I want to talk about the company, but before we get to the company, I want to talk a little bit about the macroeconomic environment and get an understanding from you about how the consumer is faring around the world right now, because you guys are in expansion mode, which is definitely not the same thing as other companies that are out there right now that are pulling back a little bit.
Absolutely. It's an interesting time. There is, without question, we are dealing with complicated macroeconomic issues on a global scale. But we do feel there's a bifurcation between, best-in-class brands that are leaders in their categories, that are innovating, and folks that are maybe, call it middle of the pack, more legacy mass market brands that are seeing, growth really slow as a result of this inflationary environment that we're in. We feel very fortunate to be, experiencing dynamic growth this year. I feel our relationship with our customer has never been stronger. We're excited about Q4 and holiday. When we look towards 2023, we are being optimistic, but cautiously optimistic. We are planning for another year of dynamic growth. We are going to continue expanding our fleet of retail stores, but we're not trying to swing for the fences. We want to lock in a number that we're really content with, not overinvest in the business, and be responsible with our growth, because there are some macro factors that we're watching very closely, and we just don't know how things will go.
No, and it's interesting too. I think at the time, about a year ago, of that SoftBank investment, which was just about a year ago, it was reported that you plan to open, Joe, more than 100 stores in the U.S. over 5 years. So as you look at those macro concerns, has that number been reduced, or that plan, that forecast, been changed?
It hasn't, actually. Okay. The performance of our stores today has never been stronger. We're still very bullish on our vertical retail expansion. Four-wall contribution, payback, still best in class. And, we're in a unique position because, relative to the size of the market, Vuori is still very much early stage. We're in our 7th year of selling in market, and there's a lot of opportunity to gain market share as we grow into the years to come. So while we might be in a more challenged macro environment, I think that will be counterbalanced by the growth and taking market share from some of the other more established players.
So talk to us about growth metrics. We're Bloomberg, we're nerdy, we love all these numbers. So talk to us about top and bottom line growth. Give us an idea, same store sales growth. What have you guys been seeing?
Yeah, I mean, this year we're seeing, the business is going to grow north of 70%, between 70 and 80% top line at a pretty sizable scale. It's a number that we're very proud of. Our same store sales are still comping very strong over prior years, demonstrating, that, it's still very much early in our awareness curve. People are experiencing the brand. We're converting them into loyalists. They're shopping with us for years to come while acquiring more new customers. So we see really great year-over-year growth in our existing fleet. And then, as we expand the network across the country, we're leveraging e-commerce data so we can be really in where we go. And we tend to open strong. And I think that trend is really accelerating as the brand builds more and more awareness.
Joe, how are you doing with inventory right now? We saw inventory challenges, of course, from Nike just in the last couple of weeks, not to mention, companies that we can't necessarily compare you to, like Target, for example. How are you managing inventory?
Yeah, it's a great question. We have definitely seen impacts from this complicated supply chain environment. Although we are seeing it begin to normalize, especially on the logistics side of the supply chain, getting your product in containers, getting it on boats and delivering on time, that has become much more normalized. The cost of a container, from Asia to the West Coast of the United States, pre-pandemic was, call it $2,500 to $3,000. It went up as high as $18,000. Now back to pre-pandemic levels or materially close to pre-pandemic levels. So the logistics aspects of supply chain have normalized, where we're still seeing a lot of challenges in the ability to source raw materials and get them delivered to your factory partners on time. So what happened to the larger marketplace is, your spring deliveries delivered late. That created promotion as we transitioned from spring and summer into fall. And then you saw the same thing happen, and it was a double whammy with the deliveries of fall being material delayed for a lot of our peers. And that's putting a lot of pressure on inventory levels. That's why a lot of folks anticipate a highly promotional holiday coming up. Vuori, while we're not immune to these challenges, we've stayed very close to our supply chain. We've dealt with delays, but nothing that's been catastrophic. And we've been able to maintain our full price business, which has been a goal of ours since we launched in the spring of 2015. And we don't anticipate an overly promotional holiday.
Joe, you probably know better than anybody else the competition that's out there, whether it's, those giant brands, including Nike, you've got Lululemon, you've got Under Armour. I mean, it's a super competitive market that could be on track for some slowing growth because, what we're seeing is people are going back to the office. I've stopped wearing my yoga pants during work. I'm back wearing, what I would call grown-up clothes in a big way. So tell us, what's the competitive advantage that gives you the optimism that you can continue on your growth trajectory?
Yeah, I think
and compete with those guys. Yeah.
Yeah, it's a great point, and it's interesting. When we launched the brand, we were facing this competition, and we saw nothing but open space. And I think it's due to our product positioning, our brand positioning, the ethos of the brand, which is built to move and styled for life. And it all comes down to building product that will support you in a workout, but it'll transition and work across multiple aspects of your life. And so we prioritize fabrications that have performance at their core, but they're incredibly soft. We design all of our products with a more modern athletic fit that works across multiple aspects of your life. And we design our product with an aesthetic, a color story that is sophisticated, that doesn't identify you as somebody going to the gym or going to compete in a sport, but it just, again, works across multiple aspects of your life. That was always the premise of the brand, and we applied it first and foremost foremost to activewear, a product that you would move and sweat in. But the brand has really evolved, and when you look at our assortment and where we're growing, it's evolved from core fitness into outdoor, which is rooted in outerwear. And the fastest growing segment of our brand is travel commute, which is taking the lessons, those technical fabrications and constructions that we applied to activewear and applying it to everyday sportswear. And that's one of the fastest growing segments of our collection. And those are the products that you're wearing to the office, you're wearing to travel, you're wearing on the golf course. And so I think our vision to build a more well-rounded collection that speaks to multiple aspects of your life is really benefiting us as you see the preferences of the consumer change.
Joe, there are a couple different directions that it seems like the company could go at this point in terms of trajectory. One of them is the Lululemon route, where you go public. Another one, and forgive me, but this has happened before. I think of a company like Outdoor Voices, which 5 years ago was the talk of the town, and has gone through several CEO transitions and a New York Times profile that essentially said that it imploded after raising about $50 million in funding. How do you avoid the fate of a company like Outdoor Voices?
It all comes down to your people, incredible leadership, alignment of your people, but hire talented people that are much better than yourself. That's been our ethos from day one, is building an incredible team that can see around those corners, and prioritizing making incredible product. We are maniacal about our product, our level of service. The NPS scores in our stores are off the charts. And I think that's the most important thing. It's a hard comparison. You look at a brand like Outdoor Voices and Vuori. I wasn't great at raising capital in the early days, admittedly. I didn't have a background building an apparel business. And so the little capital that I did get, I had to make it stretch a long way. And so we prioritized, the basics of business, the fundamentals of, acquiring customers profitably from day one. And we built a business that was profitable from early stage, and we never had to sacrifice that profitability for growth over the years. And I think that's why Vuori received, one of the highest private market apparel valuations ever, is because we've been able to demonstrate a commitment to growth, doing it profitably, and also responsibly with our commitment to ESG and making decisions that prioritize the planet as we're building.
Which is an important part increasingly for consumers. We know that they look at what a company stands for, their impact on the environment. Hey, Joe, just before we wrap up, so what's the end game here? Is it ultimately to go public at some point?
I think that could be a viable outcome. Right now, we're very heads down, building the business. We're having a lot of fun. I'm a young man. I've got a lot of energy for the business. We've got big plans for growth, both here in the U.S. as well as abroad. And so today, that's what we're focused on. But, we want to optimize the business and provide the best return for our shareholders. A public offering could be a viable option down the road.
All right, we're going to leave it on that note. Great stuff, Joe, and stay in touch so that we can hear more as you guys continue to grow the business here in the U.S. and certainly outside.
They're based in Encinitas, California, which is like the best place in the world, okay? As somebody from Southern California, Encinitas is great.
I know. You're kind of talking your book there, Tim Stenovic. All right, Joe Kudla, thank you so much. Founder and CEO of Vuori, joining us on the phone in New York City. And if you missed any of that conversation, be sure to check out our Bloomberg Business Week podcast a little bit later on.
Let's get over to some world and national news. We got Nancy Lyons standing by in our 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. Actress Angela Lansbury has died. She was one of TV's favorite sleuths in Murder, She Wrote, and she also played the teapot Mrs. Potts in the animated Beauty and the Beast.
Tale as old as time, song as old as rhyme, Beauty and the Beast.
Her children say Dame Lansbury died peacefully in her sleep just 5 days shy of her 97th birthday. Several NATO allies, including the U.S., say they will shore up Ukraine's air defenses in response to the latest Russian missile barrage against civilian targets. This is Secretary General Jens Stoltenberg in Brussels.
Our message is clear. NATO stands with Ukraine for as long as it takes.
Stoltenberg was speaking ahead of tomorrow's defense ministers' meeting in Brussels. Well, we may be 4 weeks away from a midterm election, but abortion rights advocates are looking ahead to 2024.
The advocates are looking at introducing ballot measures to enshrine abortion rights in at least a dozen state constitutions, including a few led by Republicans, where restrictive abortion laws are already on the books. Supporters may be feeling momentum after Kansas voters approved an abortion rights amendment, but the Washington Post reports some are advising caution. Ballot measures can take years to plan and cost millions of dollars, and some GOP-led states are trying to make it harder to put constitutional amendments on the ballot in the first place. In Washington, I'm Nathan Hager, Bloomberg Radio.
The MLB playoffs are underway. The Phillies lead the Braves 7-3, and the Mariners lead the Astros 4-0. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Now to Charlie Pellet for a business flash.
Thank you very much, and here's what's going on. The Dow higher today, S&P, NASDAQ both lower. In fact, the S&P during today's session fell to the lowest intraday level since November of 2020. Year to date, the S&P is now down by 24.7%. Today, the S&P dropped 23 points, down by about 0.7%. Stocks turn lower in afternoon trading after comments by the Bank of England chief on removing market support that rattled investor sentiment. The Dow held on to a 36-point gain today, up by 0.1%. Again, the S&P down 0.65%. We had NASDAQ down 115, drop there of 1.1%. 10-year yield looking at a 3.94% print right now. We have got the 2-year yielding 4.31%. Spot gold down $1.86 the ounce to 1666, a drop there of 0.1%. Bitcoin down 1%, 19,053 on Bitcoin, and West Texas Intermediate crude down 3%, 88.44 barrel. Bottom line here, stocks declined after that BOE warning. S&P lower today by 0.65%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Bloomberg Business Week is brought to you by SEI. Visionary asset managers find opportunity where others are challenged. Exploit disruption's potential with SEI's global operating platform. Find out how at sei.com/IMS.
All right, you're listening and watching Bloomberg Business Week. We're getting ready to wrap up our show, but we've got a great last guest that we wanted to get to. And just to kind of set it up, earlier this year, McKinsey pegged the price tag of a livable climate at $9.2 trillion a year. So that's the level of investment needed to reach the international climate goals of net zero emissions by 2050. And our next guest, Tim, has a guide to the risks and opportunities for investors as the world faces climate change.
Very pleased to have with us this afternoon Bruce Usher. He's professor of professional practice at Columbia Business School. He's also the author of his book, Investing in the Era of Climate Change. And I should note, full disclosure, he was my professor when I took a course from him all the way back in maybe 2017, 2018 at Columbia Business School. When climate change didn't exist, right? Yeah, this was a cool class, Investing for Social Ventures. We got to essentially serve as consultants for these startups and decide whether or not they would be awarded money. Professor Usher, great to have you with us this afternoon. How are you?
Thank you for having me on the show, and nice to chat again.
It's good to have you with us. Hey, help us understand, in a time where we're seeing global upheaval, the worst energy crisis that we've actually seen in decades, and investors are fighting for returns anywhere. How should they be thinking about investing when it comes to climate change?
Well, there's no shortage of volatility in the markets these days, but they should think about climate change from a longer-term perspective. If they're looking for stable trends, it's going to be here with us for years, if not decades, and affecting businesses for decades to come, and therefore affecting investors' investor returns for years to come. Climate change is the macro trend of the next several decades. There's just no question about that.
So, okay, and I do feel like it's going through a reckoning. Tim and I talk about ESG, right? We've seen so much money, Professor Usher, go into this space, but we're getting to a point where people really want to understand what they're investing in, and that money ultimately makes a difference when it comes to ESG metrics. But how do we make sure that investments that we make really are making a difference and are good for the climate?
Well, there's plenty of discourse around ESG these days, no question about that. And the challenge with ESG is the concept is very simple, right? It's simply saying that when you make an investment, you would normally look at financial metrics and management metrics and competition, all these other metrics. In addition, add to that analysis the environmental or social factors that are material to the company you're considering. If you're buying into real estate on the coast, you might want to think about floods and storms and the like, right? So that's ESG analysis. It's very important from an investment perspective. It makes for better investment decisions. It doesn't have a tremendous impact, though, on addressing climate change, because what you're really doing is investing in companies that are doing better at managing climate risk. But those decisions don't necessarily reduce emissions of greenhouse gases. So if that's what you're focused on, and I think that's pretty important to be focused on it, there's really two strategies to consider. One is a thematic impact investing strategy. Pick a theme or a sector that contributes to addressing climate change, say renewable energy, solar, wind, or electric vehicles, and put some investments into that sector in a smart way to maximize your risk-adjusted returns and also contribute to reducing emissions of greenhouse gases. The other strategy that's unique to really high net worth or ultra high net worth individuals is take what's called impact first strategy. So here we're really focused on climate change and invest with that lens in mind. Now that means taking very long-term investments and perhaps some additional risk. But some investors are willing to do that as well.
What I find a little puzzling in this day and age, in October of 2022, is the market has rewarded this year companies that are the antithesis of these climate-friendly companies, you could argue, right? Oil and gas companies. I mean, you look at the best performing stock in the S&P 500 this year, Occidental Petroleum up 120%. For the first, third, fourth, fifth, sixth, seventh, eighth, ninth, and 10th companies that are the best performing in the S&P 500, they are all oil, gas, natural resources companies. So what's an investor to do in this environment?
So two things to think about with oil and gas. First of all, that was from very low price points a year ago, right? So the multiples on those companies are still very low. Secondly, many of those oil and gas companies are aware of climate change and aware of their business models and how they're going to change them. So Occidental Petroleum, as an example, has invested heavily in direct air capture and some other technologies to ideally reduce their emissions over time. So they're also thinking long term. I'm not saying whether their business model is the right one. Actually, we don't have much clarity on oil and gas strategies around climate change yet. But it's not as if those companies are ignoring the issue altogether. At least the vast majority of them are now taking action on that. That being said, I said a few minutes ago, climate change is a long-term trend, and what we're seeing in the markets right now is short-term volatility, right? Oil, gas prices are up dramatically in the past year, and those stocks are going to do well in the short term.
But is there going to be, it's interesting, on a day when we heard from Cathie Wood of ARK Invest, who obviously stresses disruption, innovation, is there going to be this uncomfortable pivot, forgive me for using the P word.
You have to drink now.
But is there going to be an uncomfortable pivot, at least in the public markets, as we do shift away from carbon-based fuels, as we move to alternative energy, more EVs, because we really are turning our backs on companies that have been so much a part of our public markets in some ways, and there'll be new leaders in the market. So will there be some dislocation, some discomfort as that happens?
Absolutely.
Okay.
Absolutely. Look, climate change is two words, right? The second word is change.
Yeah.
And there's going to be environmental change, but there's also going to be a lot of change in business as this decarbonation takes place through the global economy. There are going to be companies that are winners and companies that are losers. There's just no question about that. From an investment perspective, the key question, of course, is who's going to win, who's going to lose. And here it gets a little challenging because in some sectors, the disruptive companies, new technologies, really have an advantage. I mean, just look at the automotive sector, and Tesla just completely disrupted it. And we saw what happened to values both in Tesla and then competitors. Some other sectors, though, the incumbents have big advantages. And sectors where there's a lot of regulation or big balance sheets are required, for example, utility sector, there were companies that have tried to disrupt utilities for a number of years now. NextEra took a look at what's going on, started investing heavily in renewables, is now the largest owner of renewable energy assets in the country, and more importantly, is the most valuable utility in the country today, one of the most valuable energy companies in utility. So, picking those winners and losers as this transition happened, use the word pivot, I would use the word transition, but this change that's coming is critical.
How much do you watch? It's funny, when Tim and I were at Milken, was it in the
May.
Spring?
Yeah.
We spent so many of our conversations talking about the private markets versus the public markets. How much do you watch what's going on, especially when it comes to disruption, innovation, that pivot that's happening as we think about the climate? How much of what we really should be keeping an eye on is where those investments are going on in the private markets to give us an idea of who will be ultimately the leaders in the public markets in the years to come?
Absolutely. The private markets is where a lot of the innovation occurs. That's where venture capital flows. That's where a lot of private capital is flowing from high net worth individuals. We should look at what's going on. Look at what Bill Gates and Breakthrough Energy Ventures are investing in. Look at what a number of the VC funds are putting into what they call climate tech. And let's see, which of those become the winners in the various sectors. Sectors I would focus on: green hydrogen, whole new sector, could absolutely revolutionize a lot of industries today. Direct air capture, much riskier, much harder, but could revolutionize the way we address climate change. And then there are a whole lot of other technologies around energy storage and transportation, all early stage, not competitive commercially yet with the incumbent companies, but a lot of opportunity and promise there.
So don't make fun of, I don't know, Rivian or like whoever's out there, right? We love you, Rivian. No, I'm just saying no view at all. But I mean, there's going to be stumbles, right, as we make this change.
Absolutely. Yeah, look, the parallel here is, I teach at business school, right? And if we go back 30 years, when I graduated from business school, the big thing that came, and we didn't see it coming really, was technology. Technology changed all businesses, and we looked at television. Even when we saw technology coming, it was often hard to know which companies were going to win. Netscape was the biggest internet company there for a while and doesn't exist anymore. Google came along, and it's still dominant. Those changes in the world of technology, and specifically digital technologies, have revolutionized business in so many ways and resulted in a lot of change. We look forward 30 years, that's climate change. Climate change is going to have a similar impact on businesses. And it's tough to predict which specific companies are going to come out on top.
Bruce, where's the drive going to come from when you think about investors, when you think about just business risk, or you think about the government? Is this something that these companies are going to do on their own, or does the government need to step in and create regulations that guide them?
Yeah, so this is an interesting moment. And the reason why I wrote the book now, I could have been working in the sector for 20 years. I could have written it some years ago or waited a little longer. We're at a very interesting moment in time here because there's multiple drivers going on at once, right? One driver is the physical risks of climate change are manifesting themselves. Increasingly, we're seeing climate change play out physically, and so that affects people. Consumers are starting to demand more sustainable products. Employees, they want to work for companies they believe are sustainable. These are all real trends. And there's a lot of academic research that show that these actually affect the businesses. Then you've got government stepping up more than ever. It's not consistent, particularly here with parties change. But the Inflation Reduction Act is by far the largest government support ever in this area, and that has big implications. And then the greatest change of all is around innovation. So we have products like solar and wind and electric vehicles that are revolutionizing industries, and also really starting to bend the curve on emissions. Here in the U.S., most people don't realize we actually peaked in our greenhouse gas emissions back in 2007. We actually are on a downward curve, not nearly quickly enough. We have to accelerate this transition. But this innovation in technologies is really making a big difference.
So we have about a minute or so left here, and there's a line in your story with a graphic or a picture. Investors should climate-proof their investments by mid-century in line with the recommendations of climate scientists. So I'm thinking about our investors, people who are listening to this show, listening to you speak, listening to this interview. What's the takeaway at this point when they think about their investments and maybe their strategy, their time frame, and the like?
So the initial reaction to that may be, well, mid-century is an awfully long time from now. It's almost 3 decades, and I'm gonna be pretty old. Hold on, still here talking to you then. But investments are priced; they're valued on future cash flows and future expectations around the value in those assets and those companies. And it's becoming increasingly apparent that the world is going to decarbonize. By the way, whether or not governments make it happen is going to happen because climate change is basic physics when you get down to it. Physics are going to force us to do this. So you're looking at your investments, think about how they're going to be affected, not 30 years from now, but how they're going to get affected in the next couple of years as these changes really start to manifest themselves, and then reposition around that.
Fascinating, and I think just so relevant to so much going on, especially as we continue to see the impact of climate change and then think about how it plays certainly into investing strategy. Bruce Usher, thank you so much. Hopefully we can catch up with you soon again in the future. Professor of Professional Practice at Columbia Business School. Check out his new book, Investing in the Era of Climate Change. It is just out.
Great book, great class. You know, there are those professors.
How'd you do? A, B?
Yeah, you're not allowed to talk about your
Pass,
grades.
fail?
You're not allowed to talk about your grades at business school. It's a rule. Nobody can see your grades.
Did you never talk about it? Come on. Over a beer at the pub?
You know everything's on a curve in business school? Isn't that amazing? And there's not ABCs. It's
Got off easily, huh?
H plus, I think, HP.
High pass.
Yeah, that's pretty great.
All right. An incredible show. If you missed any of it, do check out our Bloomberg Business Week podcast. Find that online, also wherever you download your podcasts.